Is the stock market a casino and can you really time it? The efficient market hypothesis states that you will always revert back to mean. That you may have periods of crowd psychology, but generally you always revert back to mean. I feel the efficient market hypothesis in the long run has its grounds, but the market is far from efficient in truth. So we can have reversions from mean for an extended period. In fact, there can be new paradigms of valuation, but those are also often proven to be, it's different this time, only for it to be found out not to be so. So the stock market captures the voting machine of opinion of what a share or an equity may be perceived to be worth. And it is, however, subject to forces such as supply and demand. If there is a wall of cash that has no place to hide, valuations can be pushed too far. And that normally needs recognizing. I don't see it as a casino, however. It serves a better purpose than that in terms of its capital raising ability for small businesses, and investment farm for people that use their heads, invest in wise industries and well-managed businesses. But you can have substantial moves from a true valuation as much as such a concept exists. So that was the one thing. Technical analysts believe that timing is possible. It can even, in select criteria circumstances, even become probable. There is never, however, a guarantee. In other words, it's almost like a Newtonian or an Einstein discussion in space. Something that is moving will continue to move unless an equal and opposite force is applied to it. So in the sense of a trend, you view that, you come into a continuation pattern, you have a trend on balance of probabilities, that trend should reassert. And you should be able to get a fairly decent entry point with a nicely tightly managed stop loss, and on balance of probabilities you should be able to get the move correct if you're choosing really selective points in price behavior, and that is not the ramshackle everyday ebb and flow.